Alrighty, so PayPal. This stock obviously hasn't done a dang thing this year in terms of the stock price, right? The fundamentals of the company are looking very good, never mind this massive change that's about to come that we're going to talk about, right? But the stock price hasn't done a thing. It's up 1.5%. So it's underperformed the stock market so far this year, right? Well, things are about to get a whole lot better in regards to PayPal's stock price and in regards to the fundamentals of the company. Here's what we have going on, and this is why it matters significantly. Out of the Wall Street Journal here just hours ago, PayPal is planning an ad business using data of its millions of shoppers, and we know PayPal has hundreds of millions of people using either PayPal or Venmo. Payments company hires Uber's former head of advertising to run the new ad division. PayPal hopes to boost its growth by starting an ad network juiced with something it already owns. Data of its millions, I don't know why they keep saying millions of users, hundreds of millions of users. The digital payments company plans to build an ad sales business around reams of data it generates from tracking the purchases as well as the broader spending behaviors of hundreds of millions of consumers who uses its service, which include more socially enabled Venmo app. PayPal has hired Mark, who formerly led Uber's advertising business, to lead the effort as senior vice president and general manager of its newly created PayPal ad division. Listen, Alex Chris, he is showing off left and right, okay? Not just in regards to these new businesses and getting their old businesses supercharged, right? But in bringing in talent on talent on talent. It's incredible. In his new role, he will be responsible for developing new ad formats, overseeing sales and hiring staff to fill out the division. PayPal in January introduced Advanced Offers, its first ad product which uses artificial intelligence in the company's data to help merchants target PayPal users with discounts and other personalized promotions. Advanced Offers only charges advertisers when consumers make a purchase. Online marketplaces eBay and Zazzle have begun testing it, according to PayPal spokesman. But PayPal now aims to sell ads not only to its customers, but to so-called non-endemic advertisers, or those who don't sell products or services through PayPal. Those companies might use PayPal data to target consumers with ads that could be displayed elsewhere. For instance, on other websites or connected TV sets. PayPal processed 6.5 billion payments by approximately 400 million, thank you for mentioning the number now, 400 million customers in the first quarter, according to its most recent earnings. Quote, if you're someone who's buying product on the web, we know who is buying the products where, and we can leverage that data, said Mark. Consumers who use PayPal credit card would also provide the company with data from real-world brick-and-mortar stores as well. Apart from its data-driven ads, PayPal has also begun running some untargeted merchant offers on Venmo, the spokesman said. The company, however, wants to avoid alienated younger users who see Venmo as sort of a social network. I don't know how much we're going to go into that, okay? By overwhelming them with promotions. Many companies have built or are beginning to build ad networks to leverage data they already have from their customers to target ads for outside marketers. PayPal, like other businesses that process transactions of all sorts, might eventually demand higher ad rates than some retailers' ad networks do, because it can provide a more detailed picture of the people advertisers are targeting, according to this gentleman that's leader of this consulting company, right? For instance, PayPal might group consumers by their relative affluence or their status as business travelers, right? They've got an immense amount of data, and their data could be worth a lot more than just general data because they're seeing the whole process through to actually the payment being made, right? Very, very valuable. Now, this is significant for the stock price and the fundamentals of the company moving forward, okay? Let me start by saying this. Did you guys see how many people picked up this article over the last several hours, right? Wall Street Journal ran that piece 11 hours ago. Then The Verge ran a piece 2 hours ago. Barron's picked it up 7 hours ago. MarketWatch picked it up 9 hours ago. Payments picked it up 3 hours ago. The Independent picked it up. I'm seeing just website after website picking up this. So this is going to get a lot of attention out there in general, which definitely can be very helpful for the stock price as people realize, oh my gosh, this is a new huge business opportunity for PayPal here. Now, when you look, right, a stock like I own, Amazon, their advertising business, no one even thought about their advertising business 10 years ago, right? Now you really think about Amazon's advertising business. They keep taking market share from Google and Meta, right? And Google and Meta continue to grow their businesses bigger. It's just the pace of growth of Amazon is much faster, right? They're supposed to grab about 15% of the advertising market share by 2025. Now, in regards to Amazon, right, their advertising business should be at a run rate of $50 billion plus a year, which is massive, right? Keep in mind that's Amazon's third biggest business. Their e-commerce business and AWS dwarf this number. But $50 billion plus a year in ad business. For reference, PayPal's entire revenue last year was under $30 billion. So think about how big of an opportunity this is for PayPal, right? And so here's where the question begins. Is this like $1 billion a year opportunity in terms of revenue? If it is, that's going to help out, PayPal's revenue by 3% plus a year, right? Is it like a $3 billion a year type opportunity? Then we're talking 10% help, right? Is it more like a $5 billion a year opportunity? Then it's like a 15% plus help to the top line. Is it a $10 billion plus a year opportunity? Then that's like 30% plus help to the top line. Is it like a $15 billion a year opportunity? Then it's like 50% help to the top line, right? And I think that's a real question. There's no question in regards to this business long term as far as it's $1 billion plus opportunity. There's just a question of how many billions of dollars. If it was only a couple $100 million opportunity, Alex Chris wouldn't even go after this. He understands this is likely a multi-billion dollar opportunity. It's just the only question is how many billions of dollars opportunity is this over the long term, right? Is this something that tomorrow massively changes PayPal numbers? No. But if you run the projections on what this does for PayPal's business model over the next 5 years, 7 years, 10 years, yes, it fundamentally changes the numbers for PayPal massively. But here's why it's much bigger, okay? Whatever you see in the top line, the number is going to be dwarfed on the bottom line in terms of a percentage how much it helps the business. Because remember, an advertising business is the creme de la creme, right? It's the most profitable, especially when you're going to be using a lot of AI. It's not like PayPal, oh shoot, we need to go hire another 10,000 employees to run this ad business. No, they don't need to do that. A lot of this is going to be systems that are already set up for customers running AI, and it's going to be a lot of self-service. So therefore, the business model is going to be incredibly profitable. So here's kind of how to think about this. Let's say this is a $10 billion a year business long term, right, in terms of revenue. It could likely help the bottom line, the net income of the company, by $5 billion. It could easily do like a 50% net margin for this particular business overall, because it's not like they're going to need to go crazy with employees. They obviously have their corporate tax rate, 21%, right? If it even got moved to 28%, okay, you can take that out. Let's say they add more systems and employees, then you got a couple $1 billion there. You're still in the plus like $5 billion a year on the bottom line. Now here's where this matters so significantly, because if you look at PayPal's bottom line, their net income, last year they did $4.2 billion of net income. So think about this. If they could build this into a business that's doing $10 billion a year top line, it's throwing off $5 billion to the bottom line, that's more than the company's entire net income today. The entire net income. But it goes bigger than that. It goes even bigger than that, folks, okay? Here's the deal. PayPal's valuation is a complete joke. The company trades, we're looking at 1000xstocks.com. This is my service, right? And we're looking at a company that trades at a 13 forward P. If you think about other advertising giants, Amazon, Google, companies like that, we're talking about 24 forward P to 42, right? PayPal is going back to a forward P of 30, in my opinion. That's where it's headed. That's where the company, when you look at how sticky the business model is, when you think about being a fintech, when you also think about the growth rates this company's going to be putting up, and then an advertising company on top, we're going back to like a forward P of like 30. So you're going to get a massive more multiple for the stock over the coming years as that advertising business builds out and people realize, oh my gosh, like this is going to become very, very valuable. It's not going to happen overnight. It's not like PayPal's going to go from a 13 forward P to a 26 or a 32 tomorrow. It happens over the next several years as that business starts to get built more and more and people realize, oh my gosh, look at the growth rates this company's putting up. Look at that advertising business, right? And so therefore you get a massive stock price gain, not just because the company's revenues and net income are going up like they are going up, right? But also simultaneously, you're going to get a big premium on valuation that's going to come into the stock over once again, the next several years. It's not like it just happens overnight. It's over a given period of time, right? Kind of like Apple. Apple used to trade at a forward P. I mean, I watched Apple years ago trade at forward Ps of like 12, 13, 14. And then you look at Apple today, even though a lot of the growth is gone, it trades at forward Ps of like 25, if not 30, right? And the reason being is now it has a services business that is very respected. Whereas if you go back 7, 10 years ago, the services business was just not respected like that, right? So we're going to see that. Hey, I want to thank you for watching this video here today on the Clips channel. I want to introduce you to 1000xstocks.com. This is the most valuable service you're going to find out there. If you're an investor in the market, this is a tool that's going to help you immensely get to the next level in the market. So when you're looking at 1000xstocks.com, you're able to understand all the different metrics laid out exactly how you need them as a long-term investor in the market. So let's say I wanted to look at a stock like Palantir. I can go ahead and type in Palantir right here, and it's going to say all Palantir's different metrics right here. Let's say I want to go ahead and look at a stock like Tesla. I can go ahead and type in Tesla right here, search, it's going to give me all Tesla's metrics right there. Let's say I want to look at a stock like PayPal. Go ahead, search it up, and then it's going to give me all PayPal's numbers laid out right there. Compare feature is one of the most valuable features of any service literally in the world. And the reason being is you're able to compare 3 different stocks all next to each other in a matter of seconds. It's absolutely, there's no service you're going to be able to find something like this. So let's say I wanted to find out, what do I think is a better buy? Do I think it's Meta? Do I think it's Google? Or do I think it's, let's say, a stock like Microsoft, for instance, right? So I can go ahead, type all those in there, and then hit compare, and boom, in a matter of, what was that, a second or two, it gave me all the metrics out. So now I can say, okay, Meta's forward P is trading at this, Google's forward P is trading at this, Microsoft's trading at this, and I can go ahead and understand this on a very high level. Additionally, we have earnings calls on here as well. So if I need to listen to any companies I own or am researching their conference calls, I can do it right here through the service. So let's say Tesla, if I want to pull up Tesla's latest conference call, boom, I can play it. I can adjust the speed as well. So if I want to listen to it at 2x speed, I can listen to it at 2x speed, 1.5x. I also have the transcripts of the conference calls as well right here. We're also working on a lot of different new features behind the scenes. So if you would like to apply for access of 1000xstocks.com, go to 1000xstocks.com and you'll be able to fill out an application and go from there. Now, next thing is up here is the man's on a freaking mission. I mean, Chris is on a mission. I can't believe how much progress this man has made in such a short amount of time. Remember, he just started with this company back in the fall time. And here we are in the spring. It hasn't even been close to a full year with him at the company. And I'm just looking at the numbers and how much better the fundamentals of the company are getting, despite the very challenging macro, right? And I'm looking at all the new products and services they're working on. I'm blown away. And this man said many months ago, prepare to be shocked. I don't think enough people realize what's going on at PayPal. And I think over time they're going to realize, and they'll realize, the thing that will make them realize more and more is when the stock starts to move. When all of a sudden this is an $80 stock, $100 stock, $120 stock, more and more people are going to start to realize what's actually going on here in the company. And all these things I'm talking about today, and I'm explaining what's going to happen 6 months from now, 12 months from now, 18 months from now, people will start to realize that. All these things I'm talking about right now. And then all these things I'm talking to you guys about right now, analysts are going to be talking about this stuff 6 months from now, 9 months from now, 12 months from now, 18 months from now. You're here listening to me. I'm just laying out the future for you and what's going to transpire. And the more the stock price starts to appreciate over the next 6, 12, 18 months, the more people are going to start to wake up to this story and start, oh my gosh, PayPal, there's stuff going on here. Oh, they got this going on, they got that going on, right? It's a process. It's a whole process. And I'm just the guy that's here to break the news before the news is really broken on how all this stuff is going to play out. And then everybody will pick up that over this next 6, 12 months, okay? So that's the moral of the story. Alex, Chris, well freaking done, man. You are doing very, very well. I am very, very happy with that man as CEO. Holy smokes. That's no jokers. Well, here's what's going on with Celsius. Celsius slumps after Nielsen data cools a bit. Now, Nielsen's basically a company that they have like the transaction data for how many different products are being sold. So for instance, back when I used to own Monster Energy back in the day, Nielsen data, they would bring that up all the time, and how the track channel data from Nielsen was doing versus their peers, their competitors for the energy drink category in general. And then you got to know, okay, the energy drink category, because that was always important for Monster, is growing at X number, and Monster's growing at this number, so you'd want to see their growth outpacing that, right? So here's the deal. Celsius slumped in early trading on Tuesday as it's more than slumped, it crashed. It's down 17% as analysts digested some of the latest Nielsen retail store trends. Morgan Stanley analyst Dara noted that Celsius sales growth slowed sequentially. Okay, that when you're in a growth stock, this is so important. I explained this in regards to NVIDIA. And if you want to know when NVIDIA stock will start crashing, it's when NVIDIA essentially, on a sequential basis, they stop growing at the pace they've been growing at. Let's just call it, they're growing like 5% or less. And on a sequential basis, that'll be the moment that NVIDIA stock will likely crash heavily, right? And so for Celsius, sales growth slowed sequentially to a 39% pace for a 1 week period ended May 18th. That's going to spook investors in regards to a growth stock with this sort of valuation. And its market share dipped to 10.5% for the latest week from 10.8%. Of note, Celsius pricing for the latest tracking period was down 7.2% year over year. Okay, so we got problems in pricing, right? Pricing down 7.2%, and then we've got problems in market share, right? Now, it's a 1 week period, okay? So you can't go too crazy with this. It's a 1 week period, but when you're a growth stock with a big valuation, a forward P of 70 something, right, which is triple that of what the market's trading at, if not more than triple what the market's trading at, right? Any piece of bad news is going to freak people out. And if you're talking about sequentially, your growth rate going down, if you're talking about losing market share, if you're talking about pricing being down, these are all things that are going to freak people out in a major, major way when it's a big valuation stock. And that's how you can see, even though it's a 1 week period, a stock moved down 17 percentage points here today, right? Morgan Stanley has a cautious near-term view of Celsius. The firm sees a robust runway for Celsius in the United States from increasing items per store, right? So just basically more shelf space. Improving placements in coolers, so that would be more prominent space. Usually if you're a drink company, you want to be somewhere around the 4.5 foot level to about the 5.5 foot level. That's usually the best, maybe 6 feet. That's like, how tall are people, right? like people are usually 5 feet tall, 6 feet tall. So that's right around the exact place you really want, obviously, your shelf spacing to be, right? Morgan Stanley has a cautious view, as we said, right? And growth in non-track channels, but warning that difficult sales comparisons over the next several quarters could cool sentiment as Celsius cycles the distribution and velocity growth since the Pepsi distribution began. Now, whoo boy, okay, so first thing I want to start out here, so speaking about Celsius, and we'll get into NVIDIA, is we spoke about it's had some crazy periods in regards to stock, but I want to take you back to Monster, which back in the day it used to be called Hansen's Natural Beverage, okay? So Monster, when they started growing, product launches around 2002, right? And the growth rates were ridiculous, absolutely ridiculous for Monster for many, many years, right? And so right around here, roughly, is where Monster got launched, right? So we can say it was like a 2 cent, 4 cent stock, 5 cent stock back then on a split adjusted basis. And then by 2006, the stock price went all the way up to about $4, right? So yeah, if you had a few $1,000s in that stock back in those days when Monster launched, you got filthy rich off a few $1,000s, literally, like it's insane, right? But then massive crash down, right? Over a period of time there. So the stock goes from about $4 all the way down very quickly to $2.31. So what happened here? I would almost guarantee you it was something happened in which sales numbers looked a little weak for a given time period. Then the stock goes parabolic from about $2.30 all the way up here to October 2007 at about $5.67, right? And then what happens after October 2007? I hope you know the great financial crisis hits, right? And the stock market gets absolutely destroyed. and especially growth stocks specifically. They got hit even harder. So Monster went from a stock that was $5.67 down to a price of under $2 a share, right? Absolutely obliterated. Then growth rates start coming back. It makes a parabolic run. It bottoms out in 2008. Actually, it bottoms out before other stocks bottom. A lot of other stocks didn't bottom till around here, February 09. Monster had already bottomed in the summer of 08. But it goes from less than $2 all the way to $12 in 2012, right? Absolutely epic. Now, when I got in Monster, it was kind of around, we can call it, I was buying Monster shares on and off kind of around this entire period here, right around there. And then Monster, and especially this one, really got me interested in Monster in a major way to invest, because it went from 12 all the way down to about $7 in a very quick amount of time, on a split adjusted basis, of course, right? And then it went on another epic run, right? Stock came back, but at the end of the day, like, we know what they did. But that's Monster, right? And so Monster was tremendous stock over time. We can see the gain, 63,000%. It's literally one of the best stocks in the entire stock market the past 20, 30 years. But the deal is, in regards to Celsius, is can they become a monster? That's what they got to do. If you're talking about this sort of valuation, right? Celsius has to become a monster. They have to become a $50 billion, $100 billion type company, a massive drink giant. Because when you look at Monster Energy nowadays, it's not just Monster. They've got a million different flavors and different types of Monster, right? And then additionally, on top of that, they also own the Reign brand as well. They also own Bang Energy nowadays. If I recall, they also own NOS Energy. I mean, they own, nowadays, you go into a convenience store and you look at the energy drinks, and Monster owns many of the brands that are there. It's not just Monster now at this point in time, right? So, can Celsius become that? Well, here's the deal. Celsius is trading, obviously, very, very rich. I mean, look at the forward P. It's significantly higher than even a stock like NVIDIA, which is, whew. But these drink companies are usually looked at as some of the holy grail of business models. SaaS companies are the holy grail of business models, but then drink companies are almost like SaaS companies a little bit in terms of what people are willing to pay. Why are people willing to pay big premiums? Like, you look at Coca-Cola and Pepsi, even those stocks usually trade at a premium to the market. And I mean, the big days of soda growth is long gone. We all know that, right? And so you're looking and you're like, why would people be willing to pay significantly over market multiples for drink companies? I'll explain why. If you think about a drink company, right, you think about getting somebody in your ecosystem and then enjoying that product day in and day out. And then every time they go to the grocery store, the convenience store, the club store, right, Costco, Sam's Club, they're buying that same product again and again and again. And with energy drinks specifically, they're very addictive products. We all know this, right? There's massive amounts of caffeine, if you know anything about the human body and the mind and all these sorts of things. Very addictive products, okay? Celsius sells very addictive products. Monster sells very addictive products. Celsius, some of their products are insanely high in caffeine and other things, right? And so, nonetheless, people don't just drink them because they like them. They drink them because they become addicted to them, okay? And so that's the kind of the magic in regards to these business models. So then somebody starts drinking Celsius, and then they're still drinking Celsius 6 months later, 2 years later, 4 years later, unless they feel like, it's negatively affecting their health, and then they finally will give it up, right? And same thing for Monster and those sorts of things, right? These products usually have very good gross margins and margins in general. Look at the net margins of these companies. Is it NVIDIA? No, but it's still great net margins on these companies, usually 20% plus, right? And if you look at Celsius, very strong revenue growth expected this year and next year. But the question is, will they actually be able to put up that growth, next year? And when you see something like this, you've got to look and because, 1000xstocks.com, what we're doing, we're taking, analyst kind of opinions there, right? And kind of funneling it down to what's kind of average estimates from kind of what we're seeing out there, right? You got to wonder, are analysts off? Maybe the company doesn't grow 41% next year. Maybe they grow 20%, 30%. And then if you're talking about, let's say they're going to grow 20% instead of 40% next year. Well, suddenly you're not going to be willing to pay nearly as high of a valuation. If a company's growing 40%, you're willing to pay significantly more than if a company's growing revenues at 20%, right? That does not mean your company's finished. That does not mean that stock's done forever. That just means the valuation has to come down, right? And so, like, if all of a sudden everybody became confident that, let's say, Celsius is going to grow revenues 20% instead of 40%, well, suddenly people might be willing to pay $50 for Celsius stock instead of what they're paying today at $77 a share, or what they were willing to pay on Friday, which was $90-something a share, right? That's where you get these big downfalls of business models overall, right? So I can't make a strong case for or against Celsius. I can't. What I can say is obviously they've done a tremendous job growing the business, right? And growing the brand. But now things get much harder for them because now they have to grow into an overall drink giant. The market cap on this is a $20 billion plus market cap from what I remember. So now they need to become Monster. They need to become Red Bull. They need to become Coca-Cola. They need to become Pepsi. And can the company do that? And that's a whole different set of questions. It's one thing, can you grow a successful drink brand and get a lot of customers behind you to support your product and drink it day in and day out, right? It's another to say, can you become Coca-Cola? Can you become Pepsi? Can you become Monster? Can you become Red Bull? It's a whole different ballgame, right? And I can't confidently say that they're going to be able to become that. I can't confidently say they're not going to be able to become that as of right now. It's just, so for me right now, I think it's kind of a no-touch situation. And, I'll do some more study on the company. At the end of the day, if I wanted to buy Celsius, I either need to get this valuation at half of what it is right now, if not 60% down from here, or I need to be very confident that this company will be Monster. They will become a $50 billion, $100 billion market cap. And they can grow that big. So it needs to be one of those two scenarios need to happen for me to go ahead and say, you know what, I got to start buying Celsius. So we'll see what happens here. Now, here's the deal. Okay, if you're wondering, is this stock about to go a lot lower over the coming next couple weeks and next couple months? If we keep getting in track channel data that looks weak and they're losing market share and pricing's bad for the next several weeks, this stock will not stop crashing short term. It will fall another 20, 30, 40%. Because that would just kind of confirm everything we're seeing here. Now, if we see a major bounce back, market share bounces back, pricing bounces back, everything's looking good again, then Celsius will be right back to $90 to $100 because then people will say, the growth story's back on. That was just a fluke thing. Don't freak out over that. This is just like the initial wave of people kind of panicking just some of the early folks got out. If all of a sudden you get next week, the following week, more bad data, that's when you talk about big folks start to exit the stock, and you talk about some major downward pressure on the stock. And also, next thing you know, Celsius shares are, $60, $50, $40. And it happens quick. But the numbers have to keep, getting worse and worse for Celsius for big money to say, oh, dude, we're moving on. We're out of here for now. We'll come buy it back. Because we know Wall Street has no, thought process long term. They actually don't really care about Celsius's next 5-10 years. They don't. They care about Celsius's next 6 months. They care about what's the numbers this coming quarter, what's the numbers a quarter after. That's about it. And if all of a sudden those growth rates and those quarters come into question, that's what big money says. We're out. We'll come see you when you get your numbers right again.